Booms and bubbles. The stock market is the story of cycles and of the human behavior that is responsible for overreactions in both directions. Seth Klarman. It all starts with excess liquidity when too many hands start chasing a few assets. People find it difficult to place their capital, and prices start going up. Initially, prices remain closely relevant to fair values, and people start realizing small profits by flipping assets. Rising prices establish proof of concept, and more people join in. People brag about their realized and paper gains, and it becomes a self-fulfilling prophecy. People feel good, and the cycle continues. Sometime in the middle of the cycle, speculators join in. Momentum crowds come in, and prices soar. It feels so easy to make money. Buy today and sell tomorrow. Don't hold the bag, pass it on. Play the game of hot potato. You've got to dance until the music is on. For sure, contrarians are there. They realize that prices are reaching unsustainable highs. They bet on the reversal of prices but get crushed. This moment in the bubble cycle is called the bear trap. Prices fall a little but quickly start going back up again. There is too much buying pressure for a few short sellers to handle. After massive losses, these bears throw in the towel and buy their position out. Prices leap, and in a couple of sessions, prices rise multiple folds. This phenomenon is called a short squeeze. Now, there is no longer a true seller left in the market. People start flipping more, and prices rise without any check. Towards the end of the boom cycle, the general public starts investing money. People sell their houses and join the game. They invest their life savings into these inflated prices without understanding the underlying nature of the assets, associated risks, and without any prior experience of investing. Suddenly, every radio and TV host starts talking about fantastic investment ideas and invites industry gurus onto their broadcasts. These gurus come with got-rich-quick stories of their clients. Most of these programs are paid transmissions. These are commercials, but the general public does not understand. All they see is the big dollar sign that can be their reality in the near future. Then reality sets in. Prices drop a little, and people think it is an excellent time to buy. At this time, professionals cash out their chips and come out of the market. They know that not much gain is left. However, people who joined late are the ones who buy from them, thinking it is just a small drop and the market will continue its course. Prices go up a little for a week or two. This phase is called the bull trap. People think that the drop is over and the market has started going back again. Then the real fall comes in. The market drops sharply in the blink of an eye. People just freeze, unable to take any action. Within weeks, the market drops so much that selling at these prices makes no sense. It makes no sense for people who bought at the peak, but generally, it is still rational to sell these inflated prices weeks into the fall. It repeatedly happens, more often in pump and dump schemes of penny stocks and less frequently in asset classes like marijuana stocks or cryptocurrency. Even less often, this happens in narrow market segments like the dot-com bubble of the 90s or the Nifty 50 stocks of the 60s. Causes and signs of booms and bubbles. Factors that contribute to a boom are 1. Excess liquidity. 2. A widespread belief that prices can only go up. 3. Complete ignorance of associated risks. 4. Universal ignorance of the relation between price and value. 5. Presence of party culture, gambling mindset. 6. Widespread speculative activities. 7. Mushroom-like growth of financial gurus, advisors, and enablers. 8. People who never invested a penny in their life have started asking for and giving investment advice. 9. Stories of people who got overnight rich become the everyday talk. 10. People started selling their houses and life savings to participate. 11. Cult-like behavior of investors. Any disagreement or prudent advice is considered a threat or an enemy. 12. Fear of missing out. FOMO takes over cautions and prudence. 13. Mocking of seasoned investors who are sticking to their rules and letting the easy money pass by. If you see these signs, even half of these, run for the hills. Let's start with excess liquidity.